but it's not hit people with variable rates at this variable rate mortgages at this stage.
Now, do we know why? Is it simply banks competing for market share and they don't want to frighten the potential mortgage seekers away?
Yeah, I mean, there's various reasons, but I think the most obvious one is we're still a nation of savers. I think our hands have been burnt slightly by coming out of 2008 and the financial crash. So we've actually got more on deposit. We've got 150 billion on deposit, whilst we've only the banks are only going to lending around 100 billion. So actually, it suits the banks to keep deposit rates low. And then not pass through higher rates to variable customers. So ideally, if there weren't these international players in the market, the banks would make more by just keeping the status quo. But I mean, it is a forecast, Pat, but based on kind of some sensible assumptions about how much the banks are going to have to increase their interest rates by, we could probably see variable rates rise to around 5.5 from currently they're around 3.5, so another 2%. So that would add about 111 a month to the average mortgage repayment. And that's quite a big hit. It's actually 17,000. If rates stay at 5.5%, that would be 17,000 over the average mortgage term. So it's a big increase in the cost of the average mortgage. But the biggest thing that I would say is talk to a mortgage broker. There are fixed rates available of 3.95% for up to 30 years. So you can now fix much lower than 5.5%. for the whole term of your mortgage. So if we take that example, Pat, of those 111 increase in your monthly repayments, if you were to fix at 3.95 on the average mortgage, that would just be an increase of 25 euros a month, and you would be capping your mortgage rates. Yeah. For the rest of your term.
And there are people who would rather do that and have fixed payments, which with inflation over time would become fairly insignificant, and they would not be at the mercy of the up and down interest rates that might persist. They may pay more in the long run, but they have that security of knowing precisely what their outgoings will be for the next 30 years. Mark,